So, are you on the lookout for a truly wonderful company to potentially invest in, even if its current price tag seems, well, maybe just fair? Today, we're diving deep into Arista Networks, ticker symbol ANET, to unpack why this critical player in the AI revolution might just fit that exact description. And, what that truly means for you as someone curious, perhaps even a potential investor. Welcome to the Deep Dive, where we take a stack of information and try to extract the most important nuggets of knowledge. Arista is often called the AI superhighway builder, and, well, for good reason.
That's exactly right. I mean, in this incredible gold rush of artificial intelligence, everyone's naturally focused on the chip makers, the ones selling the shovels.
Yeah, the obvious plays.
But what if the real, maybe overlooked opportunity is the company building the actual superhighways, the roads that connect all those gold mines? That's really the core question we're exploring today.
Right. So our mission for this deep dive is to really get under the hood of Arista Networks. We've gathered a big stack of information, and our goal is to cut through the noise. We want to dissect their operations, understand their competitive standing, and analyze their financial health, really grasp their fundamental value. And we're looking at this through the lens of a long-term, business-focused investor. Just so you know, all our analysis is anchored to their closing share price of $99.39 on June 28, 2025.
And we've structured this deep dive into two main parts for you. First, we'll lay the critical foundation. We'll cover Chapter 1, Business Understanding.
Right.
Then Chapter 2, Management Evaluation. And finally, Chapter 3, Financial Analysis.
Got it. Chapters 1 through 3 first.
Exactly.
And then in the second part, we'll shift our focus, right?
Exactly.
We'll look at Chapter 4, Market Sentiment in Chapter 5, Ownership Structure, a full Chapter 6,
Right.
Risk Assessment, and then wrap it all up with our comprehensive Chapter 7, Conclusion.
Sounds like a plan.
Okay, let's unpack this. So let's start with Chapter 1. Business understanding. To really get Arista, we need to peel back the layers. What do they actually do? How do they make money? Is it just, selling boxes?
Not at all, actually. It's more nuanced. Arista essentially operates with two core revenue streams, products and services.
Yep.
The product segment, that's where they sell their high-performance networking hardware. Think multi-layer switches, routers,
Right.
the critical gear for massive data centers.
Right, the physical stuff.
But then there's the services segment, and this is where it gets really interesting. This brings in recurring revenue from support contracts, maintenance, professional services.
Sticky stuff.
Exactly. And it's not just about revenue, it's a profit powerhouse. We're talking gross margins around 80% here.
80%, wow.
Yeah, compare that to maybe 60% for the product segment. That's almost unheard of for a company selling physical boxes.
That really tells you something, doesn't it?
It absolutely does. It's not just a number. It's like this flashing neon sign that proves how indispensable and sticky their software and support truly are. It means once you're using Arista, you're kind of locked in for the value, not just the hardware itself.
So let's talk about those key offerings. You're saying it's more than hardware.
Oh, much more. The core isn't just a box. It's this sophisticated software ecosystem. And at its heart is the Arista Extensible Operating System, or EOS.
EOS, okay.
Think of EOS as the brilliant software brain running everything. It's built on Linux, which makes it incredibly stable, reliable, and also flexible.
Flexible how?
Well, one unique thing is its stateful restart feature. Basically, if one tiny piece of the system needs a reboot, the entire network doesn't go down.
No way. That's huge for data centers.
It's massive. Imagine changing a tire on a car while it's still driving at 70 miles per hour. That's kind of the idea. It prevents incredibly costly downtime for their customers. Plus, it's programmable using common Linux tools and extensible, meaning it easily connects with other software. It gives customers immense control.
Okay, so EOS is the brain. What else?
Then there's CloudVision. That's their management platform. It provides network-wide automation, orchestration, real-time visibility, the whole package.
So it lets you see and control everything from one place.
Essentially, yes. It lets customers manage their entire network as one unified entity. This drastically cuts down on operational costs and, importantly, human error.
Okay, I like the analogy you used before. The hardware switches, routers, they're like the powerful vehicles.
Right.
But EOS and CloudVision, they're the advanced operating system and the navigation AI that actually make them powerful.
That's a great way to put it. It's like buying a high-performance sports car. But Arista doesn't just sell you the car. They build the entire ecosystem around it. The custom-tuned engine, that's EOS. The GPS that knows every shortcut and traffic jam, that's CloudVision. And the pit crew keeping it running flawlessly 24/7, that's their services arm.
That ecosystem really seems like the key differentiator.
It is.
Now, what about their place in the market? Their scale?
Well, in terms of market position, Arista is an undisputed leader in their niche data center networking. Gartner, the big tech research firm,
Yeah, sure.
they've consistently named Arista a leader in data center switching for years now, and they specifically highlight Arista's highest ability to execute. That says a lot.
And scale. Are they big?
Oh, yeah. Their scale is genuinely impressive. They've shipped over 100 million cloud networking ports. That's 100 million to more than 10,000 customers globally.
Wow, okay.
But what's truly fascinating, I think, is the ultimate endorsement. It comes from their customer list. We're talking the cloud titans like Microsoft and Meta Platform.
The biggest of the big.
Exactly. These companies operate infrastructure at a scale that, frankly, few can even comprehend. Their decision to build their critical networks on Arista's platform, that creates this incredibly powerful brand halo. It attracts other large enterprises who basically want to copy the best.
Makes sense. So Arista's main pitch, their value proposition, seems to be about openness, automation, lowering the total cost. Kind of the opposite of some older vendors.
Precisely. They contrast sharply with legacy vendors, and they achieve this through a couple of key strategic choices. First, they use merchant silicon.
Merchant silicon.
Meaning off-the-shelf chips, primarily from Broadcom. This lets them focus their own R&D fire hose on the software, on EOS, and it helps them get to market faster and more cost-effectively.
Smart. And the second choice?
Building everything on that single, open, Linux-based EOS, this is huge for customers because it helps them avoid vendor lock-in, it gives them flexibility, control. They're not trapped.
Okay, it's clear Arista has built a really solid internal foundation, a unique approach. But let's zoom out. Where do they fit in the bigger tech landscape?
Yeah.
They seem to be at a crossroads of some massive trends, right?
Absolutely. Right at the intersection. First, cloud computing. That market is expected to grow, 18.7% CAGR, something like that, hitting nearly $2 trillion by 2030. Massive.
Huge tailwind.
And then there's artificial intelligence. AI networking specifically is growing over 40% annually. AI infrastructure spending overall, expected to top $110 billion by 2024. So yeah, Arista is perfectly positioned. It really reinforces that picks and shovels analogy for these new digital gold rushes. They're building the essential infrastructure.
Okay, but who are they actually up against? The competitive landscape must be intense.
Oh, it is. You've got the legacy incumbents, the historical titans like Cisco Systems, Juniper, Dell, HPE are in there too. And Arista, to their credit, has been very successful, taking significant market share from Cisco in the data center for, over a decade now.
But there's a new challenger, isn't there? The AI behemoth.
Yes, NVIDIA. They're a formidable player now in networking too, not just GPUs. They have their proprietary InfiniBand technology, which currently holds something like a 90% market share in AI training networks. That's dominant.
90%, wow.
Yeah, and they're aggressively pushing their integrated solutions like Spectrum-X. So this really sets up the central strategic battle in AI networking right now. It's Open Ethernet, championed by Arista and others, versus proprietary InfiniBand, dominated by NVIDIA.
And Arista's fighting back.
Their countermove is being a founding member of the Ultra Ethernet Consortium. That's an industry alliance working on the next-gen open standard to compete directly with InfiniBand.
Interesting. Why would the big cloud players prefer an open standard?
That's a key strategic point. The cloud titans generally have a strategic aversion to being locked into a single supplier for critical tech. It limits their bargaining power, increases risk. So having a strong, open alternative like Arista provides is vital for them. It helps balance out the NVIDIA influence. Arista becomes a crucial partner.
Makes sense. What about regulations and other external factors?
Well, like any global tech player, Arista deals with the usual ESG factors, environmental impact, data privacy rules like GDPR in Europe or CCPA in California, standard stuff.
But there's something more specific impacting them now, right?
Yes. Geopolitics. Specifically, the 2025 U.S. tariffs on goods imported from China. There's a 30% baseline tariff now. Since Arista manufactures components there, this directly hits their cost of goods sold. It's a significant factor we'll dig into more in the risk assessment chapter.
Okay. And is this market easy to just jump into? Barriers to entry?
Oh, incredibly hard. The barriers are high. First, you need immense technical expertise and R&D muscle. I mean, think about building an operating system as complex and reliable as EOS from scratch.
Right, not a weekend project.
Not at all. Then there are significant economies of scale needed to compete on price. And building brand trust, that takes years, even decades, especially in mission-critical networking where reliability is everything.
So reputation matters a lot.
Hugely. But probably the most powerful barrier, high switching costs. Once a customer builds their automation, their workflows, their operational processes around Arista's EOS and Cloud Vision.
It's a massive pain to switch.
Massive. It's costly, it's risky. You might have to retrain staff, rewrite automation scripts. It's the classic rip and replace nightmare scenario that most companies want to avoid at all costs.
So these barriers really create Arista's competitive advantage, their moat.
Exactly.
Yeah.
Their brand strength is now synonymous with performance, quality, innovation, especially in cloud networking and even financial services. Having Microsoft and Meta as flagship customers is huge validation.
And you mentioned cost advantages earlier.
Yes, that merchant silicon strategy lets them focus R&D firepower on their software differentiator EO. It gets them to market faster, often at a lower cost for the hardware itself. Plus, their sales model is efficient. Focusing on those huge cloud titans means lower relative sales and marketing expenses compared to someone chasing thousands of small businesses.
But the real lock-in comes from the software side.
Absolutely. The true genius, the heart of their economic moat, lies in those network effects and switching costs tied to EOS and Cloud Vision. Once you've integrated, the incentive to switch is just incredibly low. It's operationally disruptive, expensive. And there's a growing network effect, too. As more third-party applications integrate with their data platform, NetDL, the whole ecosystem becomes more valuable for every single customer on it.
And then finally, any other unique assets.
Well, the EO software architecture itself, it was genuinely revolutionary when launched, designed from the ground up for the cloud era, not just an evolution of older systems. That gives it inherent advantages. And crucially, the vision and the DNA of its founding team. Andy Bechtolsheim, the chief architect, and Kenneth Duda, the CTO, they are still deeply involved. That provides a level of technical vision and long-term continuity that's, frankly, exceptionally rare in a public company of this scale.
Okay, that's a really solid foundation on the business. Let's move on to Chapter 2, management evaluation. Because, as they say, a great company often reflects its leadership.
Agreed. And Arista's management team is, well, exceptionally strong and looks really well balanced.
Starting at the top.
At the helm is CEO Jayshree Ullal. She's a 40-year tech industry veteran. She guided Arista literally from pre-revenue through incredible growth to its historic IPO back in 2014. She consistently gets accolades like being named one of the world's best CEOs.
And the founders are still key.
Very much so. Andy Bechtolsheim and Kenneth Duda, the chief architect and CTO, remain deeply engaged. That ensures the technical vision and that long-term continuity we mentioned is embedded in the company's DNA.
Have they been tested? How do they handle crises?
They have. The company was founded just before the 2008 financial crisis. Lehman Brothers collapsing taught them about adversity early on, apparently. More recently, they navigated the huge post-pandemic supply chain crisis very successfully, arguably emerging stronger than even giant competitors like Cisco.
What about communication and ethics? How transparent are they?
Generally considered top tier. High standards of transparency with investors, clear financial outlooks, accessible executives, a comprehensive investor relations website. They even have this internal cultural document called the Arista Way, which explicitly emphasizes integrity, customer success, teamwork over ego. Seems baked into the culture. And their compliance record is strong, no major ethical scandals or anything like that.
Okay, let's talk capital allocation. How do they spend their money? Reinvesting.
Primarily, yes. Their main use of capital is reinvestment back into the business through research and development. They consistently spend around 15% of their revenue on R&D, which is substantial.
Driving innovation.
Exactly. It's all about maintaining that technological leadership. This investment is guided by their internal Arista 2.0 strategy, which focuses on expanding EOS beyond the data center into enterprise campus networks, routing, and network security.
What about M&A? Do they buy other companies?
They do, but they're very disciplined. They focus on small, strategic, tuck-in acquisitions. Think buying Mojo Networks for Wi-Fi tech, or Awake Security for network security tools. These deals quickly bolster their existing product lines or accelerate their roadmap in specific areas. It avoids the huge risks and integration headaches that often come with massive mega mergers.
Smart. And how do they return cash to shareholders? Dividends.
Nope, Arista does not pay a dividend.
Okay.
Instead, they use substantial share repurchase programs, buybacks, to return excess cash to shareholders. Just recently, in May 2025, they authorized an additional $1.5 billion for buybacks. And to give you an idea of the scale, in Q1 2025 alone, they bought back a record $787 million worth of their own stock.
That's exactly the kind of thing value investors love to see, isn't it? A management team acting like owners, using market dips maybe, to repurchase shares when they think they're attractive.
It absolutely speaks volumes about their long-term conviction and how they view creating shareholder value.
Okay, let's connect this to a key metric, ROIC, return on invested capital. How does Arista stack up?
ROIC. If we connect this to the bigger picture, ROIC is arguably one of the most important metrics for assessing management's actual skill at creating value. It asks, for every dollar invested in the business, how many profitable dollars does it generate back?
And Arista.
Arista is exceptional here, a true grandmaster. Their ROIC consistently ranges between, say, 24% and 28%.
24 to 28%. That sounds high.
It's incredibly high. It's nearly double the networking industry average, which hovers around 14%.
Wow.
And then you compare that ROIC to their cost of capital, their weighted average cost of capital, or WACC, which we estimate is around 11.5%.
So they're earning way more than it costs them to fund operations.
More than double. The fact that ROIC is consistently more than twice their WACC is definitive proof that they are creating significant economic value. And here's the kicker. They've scaled their capital base, the amount invested in the business, by 222% since 2019.
Tripled it almost.
Without diluting these elite returns. That is remarkable execution. So what does this all mean for investors? It shouts, efficient, highly profitable, a well-managed growth machine.
Okay, that's a glowing review for management and capital allocation. Let's dive into the numbers themselves in Chapter 3. Financial analysis. First off, size.
Right. As of our analysis date, June 28, 2025, Arista Networks has a market capitalization of approximately $124.8 billion. That puts it firmly in the large cap category.
And revenue growth. You mentioned strong growth earlier.
Remarkable growth, yeah. Looking at the last 5 years, from 2019 to 2024, their compound annual growth rate, the CAGR, was a very strong 23.77%.
23% average growth per year.
Roughly, yeah. Revenue went from $2.41 billion in 2019 up to $7.9 billion in 2024. There was that brief dip in 2020, COVID impact, but then they just strongly reaccelerated. Explosive growth in 21 and 22.
Now, one of the most striking things you mentioned was profit margins, almost software-like.
Exactly. For a company with a substantial hardware component, it's really eye-opening. We should look at the GAAP numbers, generally accepted accounting principles, the standard rulebook.
Okay, GAAP.
Their trailing 12-month GAAP gross margin is sitting at 63.7%. GAAP operating margin is 42.8%. And their GAAP net profit margin, what they actually keep, is an impressive 40.7%.
40% net margin. That's huge.
It is. And these elite margins are really clear financial evidence of those strong competitive advantages we talked about. The software differentiation, the customer lock-in, giving them real pricing power.
What about cash generation? Free cash flow.
Arista is a powerful cash-generating machine. Now, you might notice a dip in free cash flow, or FCF, back in 2022.
Yeah, sign of weakness.
Not really, no. That was actually a deliberate strategic decision. During the big semiconductor shortage, they chose to proactively build up inventory to ensure they could meet customer demand. It hit FCF temporarily.
Playing the long game.
Exactly. And then as supply chains started to normalize in 2023, FCF just exploded, hit $2 billion and then $3.68 billion in 2024. It really highlights resilient, far-sighted management, I think.
Consistent profits, too. Earnings growth.
Very impressive consistency. If you look at their quarterly GAAP-diluted EPS earnings per share, it's gone from just $0.01 way back in early 2014 to $0.64 in the first quarter of 2025.
Steady climb.
And annually, it went from $0.09 per share in 2014 to $2.27 in 2024. That consistent upward trajectory in profitability over a decade, that's really a hallmark of a high-quality company.
And the balance sheet. Debt.
Fortress-like, minimal to no long-term debt. Their debt-to-equity ratio is practically zero, around 0.01. This gives them immense financial flexibility.
And liquidity. Can they pay their bills?
Easily. Their current ratio is very healthy at 3.93. That means they have nearly $4 of liquid assets for every dollar of short-term obligations coming due, so basically zero near-term solvency risk.
Okay, so incredibly strong financials. High growth, amazing margins, tons of cash, no debt. What does this all mean for the valuation? Is it expensive?
Well, let's look at the PE ratio first, price to earnings. That tells you how much investors are paying for each dollar of past earnings. Arista's trailing 12-month PE is about 42.15.
42. How does that compare?
It's higher than its own 10-year historical average, which is around 37-38. It's definitely higher than Cisco, which is around 28, but it's actually lower than NVIDIA, which is up at 46.5.
So kind of in the middle of its key peers, but high historically for itself.
Right. It suggests the market clearly sees Arista as a premium growth company, likely because of that AI exposure we discussed. But yeah, by traditional metrics, you wouldn't call it cheap.
Okay, that's relative valuation. What about intrinsic value? Trying to figure out what it's really worth based on future cash flows.
Right. For that, we use a discounted cash flow or DCF model. It's complex, involves making assumptions about the future, but it tries to estimate that underlying worth. Our educational DCF model.
Your model suggests.
Our model generates an estimated intrinsic value range for Arista of $95 to $115 per share.
95 to 115. And what are the big assumptions driving that?
The key assumptions are a discount rate, the WACC, of 11.47%. We assume a 5-year high growth period from 2025 through 2029. During that period, we model revenue CAGR starting strong at 17%, but gradually declining to 12% by the end of the 5 years, and then a terminal growth rate representing long-term steady growth of 3.0%.
Okay, so those assumptions are critical to that $95, $115 range.
Absolutely. Change the assumptions, you change the range. DCF is very sensitive to inputs.
Right. So that wraps up the foundational deep dive. The business, the management, the financials, an impressive picture so far. But to complete it, we need to look outward. What's the market saying? Who owns the stock? And crucially, what are the big risks? Then we can draw our final conclusion. Let's move on to Chapter 4, Market Sentiment. What's the vibe on Wall Street?
Wall Street sentiment towards Arista is broadly positive. The consensus rating is generally a strong buy or moderate buy.
Yeah. And price targets. Where do analysts see it going?
The average 12-month price target is hovering around $110 to $111. Based on the $99.39 price we're using, that suggests potential upside of about 11% or so over the next year. But there's a range, of course. Analyst targets span from maybe $87 on the low end up to $130 on the high end.
Okay, positive overall. What about recent news flow? How is Arista being portrayed?
Well, what's fascinating here is this kind of dichotomy in the recent news.
How so?
The bullish narrative, especially in the tech media, naturally focuses on Arista's critical role in AI infrastructure, their consistent earnings beats, new product innovations, all the good stuff.
Makes sense,
But the bearish narrative, which actually dominated the financial headlines more recently, points to that sharp stock drop after they reported record Q1 2025 earnings.
Wait, the stock dropped after record earnings.
Why? It seemed paradoxical, right? But it was driven almost entirely by investor fears over those newly imposed U.S. tariffs on Chinese components that we mentioned. Management guided that these tariffs would likely reduce gross margins by about 1 to 1.5 percentage points. And the market reacted negatively to that future uncertainty despite the strong current results.
So a disconnect between current performance and future worries about external factors.
Exactly. A clear disconnect.
What about other market indicators? Short interest. Are people betting against the stock?
Very little, actually. Short interest is exceptionally low for Arista, just 1.92% of the float.
How does that compare?
It's significantly below the peer average, which is closer to 6.77%.
Wow.
And it's way under the sort of 10% level that might raise a red flag. It indicates strong market confidence, very little skepticism from professional short sellers betting on a price decline.
Okay, and technically, how does the price look relative to its moving averages?
Right. Technically, Arista's share price, that $99.39, is trading above its 50-day simple moving average, or SMA, which was around $89.24. And crucially, it's also trading above its 200-day SMA. That longer-term trend indicator was in the range of $96.28 to $96.56.
And crossing above the 200 days usually seen as positive.
Yes, that recent cross above the 200-day moving average is often considered quite a bullish long-term signal by technical analysts. It can attract additional buying interest.
All right, interesting market dynamics. Let's turn our attention now to Chapter 5, Ownership Structure. Who actually owns Arista Networks? Is it mostly big institutions?
Yes, very high institutional ownership. Depending on the source, it's estimated between 69% and maybe even 82% of the outstanding shares.
And who are these institutions? Active managers?
Yeah.
Passive funds?
It's dominated by the big, stable, passive index fund managers. Think Vanguard, BlackRock, State Street. They're usually the top holders. But you also have large active firms in there, like Fidelity, FMR LLC.
What about insiders? Do the leaders have skin in the game?
Oh yeah, significant insider ownership. Again, estimates vary slightly, but it's somewhere between 3.3% and maybe as high as 18%, depending on how you count founder shares held in trusts. CEO Jayshree Ullal herself holds a substantial stake, around 3.0% to 3.5%, and co-founder Andy Bechtolsheim holds a massive position, potentially 4.7%, even 15%.
That definitely shows strong alignment with shareholders.
Absolutely. Now, you will see reports of net insider selling over the past 12 months. There were about 48 sell transactions versus only 4 buy transactions, including some sales by CTO Kenneth Duda.
Should that be worrying?
Not necessarily. It's important context. Insiders sell for many reasons: diversification, tax planning, personal needs that have nothing to do with their view of the company's prospects. Plus, you have to weigh that against the company's own massive $1.5 billion share buyback authorization. You can almost view that as powerful corporate insider buying, effectively reducing the share count and increasing the proportional ownership for everyone else.
Good point. Is ownership concentrated or widely spread?
It's fairly concentrated among the top holders. The top 12 institutional and insider shareholders collectively control about 51% of the shares. But since these are mostly those stable, long-term institutional holders and committed founders, it's generally seen as reducing risk rather than increasing it, less likely to have huge blocks suddenly dumped on the market.
Okay, that makes sense. Now, let's get to the crucial part. Chapter 6, Risk Assessment. We can use a SWOT analysis framework here: strengths, weaknesses, opportunities, threats. Start with strengths.
Okay, summarizing the key internal competencies. First, market leadership and that premier brand, especially in cloud networking, validated by those Titan customers.
Right.
Second, superior and differentiated technology, centered around EOS and its ecosystem. Third, that exceptional financial profile, high-growth, software-like profitability, fortress balance sheet. And fourth, visionary and aligned leadership with deep technical roots and significant ownership.
Solid strengths. What about internal weaknesses? Where are they potentially vulnerable?
3 main ones stand out. First, high customer concentration. That heavy reliance on Microsoft and Meta, while a strength in validation, is also a risk if either were to significantly cut spending or switch suppliers. It creates potential revenue volatility.
Dependence on a few big clients.
Okay.
Second, a narrower product portfolio compared to behemoths like Cisco, who offer a much wider range of networking and IT solutions. Arista is more focused. And third, limited geographic diversification. Over 72% of their revenue still comes from the U.S., making them more sensitive to the economic conditions there.
Got it. Now for the external factors. Opportunities. Where can they grow?
The biggest opportunity is clearly the AI networking revolution. As AI models get bigger and more complex, the demand for the kind of high bandwidth, low latency networks Arista specializes in is just set to soar.
Tailwinds from AI. Massive tailwinds. Also, their enterprise and campus expansion, that Arista 2.0 strategy to take EOS into broader markets beyond the data center, represents a huge potential growth vector. And finally, just the enduring shift to the cloud continues to provide a powerful long-term tailwind for their core business.
Okay, sounds promising. But what about the threats? What external challenges do they face?
Well, first, intense and evolving competition. We talked about NVIDIA and their proprietary stack versus Arista's open Ethernet approach. That Ultra Ethernet addle is a major threat and uncertainty. Plus, legacy players aren't standing still.
Competition is fierce.
Always. Second, the rapid pace of technological change in this industry. They need to constantly innovate just to stay ahead. Third, cybersecurity risks are an ever-present threat for any networking company. A major breach could be devastating.
And what about those broader economic factors?
Yes, key macroeconomic factors are threats. Inflation directly impacts their profitability by increasing input costs, materials, components, logistics, labor, especially if they can't fully pass those costs on to customers.
Margins could get squeezed.
Potentially. And interest rates. Higher rates increase the discount rate used in valuation models like DCF, which lowers the calculated intrinsic value. Higher rates also raise the cost of capital for Arista's customers, which could potentially slow down their large capital expenditure projects, impacting Arista's sales.
Okay, and then the specific geopolitical factor we keep mentioning.
Right. This really raises an important question. What's maybe the single biggest driver of the bear case, at least in the short to medium term, the most immediate, quantifiable threat?
It'd have to be those U.S.-imposed tariffs of 2025, right?
I think so. That 30% baseline tariff on imports from China. Arista's own management, as we said, expects these to reduce their non-GAAP gross margins by 1 to 1.5 percentage points.
Which translates to real money.
Absolutely. On $7 billion in annual revenue, that 1.5 points is potentially a $70 to $105 million hit to gross profit annually. That introduces a major element of uncertainty and margin pressure that the company can't directly control. It's a significant headwind.
Okay, a thorough look at the risks. Let's bring it all together now in Chapter 7. Conclusion. Can we synthesize the findings? Start with the bull case. Why might someone be optimistic about Arista?
Sure. The bull case really rests on four key pillars, I'd say. First, they are a premier enabler of AI and cloud, providing absolutely critical infrastructure for two of the biggest, most durable tech trends of our time.
Pillar 1. Enabling key trends.
Second, they possess a deep and defensible economic moat that's built on the EOS software ecosystem, cloud vision, and the resulting high switching costs and network effects.
Pillar 2. Strong moat.
Third, exceptional financial strength and profitability. We saw the elite ROIC, the software-like margins, the fortress balance sheet, the strong cash generation, pure financial quality.
Pillar 3. Financial powerhouse.
And fourth, superb aligned management and capital allocation. A proven leadership team with deep tech roots, significant ownership, a track record of excellence, and a disciplined approach to reinvesting and returning cash via buybacks.
Pillar 4. Great management. Okay, that's a compelling bull case. Now, flip side. Summarize the key bearish points. The bear case. Why the caution?
The bear case boils down to three primary concerns, I think. First, intense competition and that customer concentration risk. The NVIDIA threat is real, and the reliance on just two massive cloud titans for a large chunk of revenue is an ongoing vulnerability.
Concern 1. Competition and concentration.
Second, those geopolitical and macroeconomic headwinds we just detailed. The U.S. tariffs are the most immediate quantifiable hit, but inflation and rising interest rates also pose risks to margins and customer spending patterns.
Concern 2. External headwinds.
And third, a demanding valuation. The market already recognizes Arista's quality and growth prospects, pricing the stock at a premium PE ratio. This means there's potentially little margin of safety if growth expectations falter or if those macro headwinds worsen significantly.
Concern 3. Valuation leaves little room for error.
Okay, so let's bring back the valuation summary. What was that intrinsic value range again? Right, just to restate, our educational discounted cash flow model produced an estimated intrinsic value range for Arista Networks of $95 to $115 per share.
Okay, so what does this all mean? As of June 28, 2025, Arista's share price was $99 to 39 cents. That falls squarely within our estimated intrinsic value range of $95 to $115.
Exactly. And this suggests that at that point in time, the market was likely valuing the company fairly. It seems to be balancing Arista's exceptional quality and its undeniable growth prospects against those very real risks and headwinds we've discussed.
What's the final outlook?
Well, for a long-term business-focused investor, it really fits that description of a wonderful company trading at a fair price. It doesn't appear to offer a deep, obvious discount or margin of safety at this price.
Not a bargain bin stock.
Definitely not.
Yeah.
But it also doesn't seem egregiously overvalued given its quality and position. So the decision to invest really hinges on your individual conviction, your belief in Arista's ability to successfully navigate those external headwinds, particularly the tariffs and competition, and to sustain its remarkable growth trajectory, especially fueled by AI.
A wonderful company at a fair price. A classic investment dilemma, really. Requires judgment about the future.
Precisely.
And this deep dive has really highlighted that critical battle for the future of AI infrastructure, hasn't it? Arista's open Ethernet approach versus NVIDIA's proprietary InfiniBand. Which one will ultimately win out in the long run? And how will that shape the actual superhighways connecting our AI future? It's definitely a question worth pondering long after this discussion.
Absolutely. And if you enjoyed this deep dive and pondering those big questions, don't forget to like and subscribe to Stock Analytics AI.
Yeah, please do. Remember, for $4.99 a month, members get priority deep dives on tickers you request. And over the next few months, we are covering all of the S&P 500 stocks, and members get exclusive priority access to those deep dives.
And if you just want a one-off deep dive on a specific company that's caught your eye, just drop us a super thanks on the video.
As always, please remember this analysis was generated by an AI system purely for educational and informational purposes. It should absolutely not be considered financial advice.
That's right. Please conduct your own thorough research, consider your own circumstances, or consult with a qualified financial advisor before making any investment decisions.